Hi, so welcome to the stream today. Really excited for having you as we continue with our discussion for the March 2023 examination, and we want to continue with the masterclass discussion that we started last week, and wrap up on that and see what else we can do. Remember that after this week, it means that technically we have 2 more weeks to go for the examination, because the examiner is going to be starting on the 13th of March 2023, and that's technically about 2 weeks to go for the examination. And I believe that you are studying and you're working hard and you're putting yourself in the position to be able to pass the examination. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join. But most importantly, if there are any questions for me, something you would want me to share my thought on, put it in a chat for me. I'm going to be doing some Q&As quickly before getting excited into my discussion for the day. So if there are any questions, put it in the chat for me. Remember to also share the video. Let's reach as many students as possible so we can together assist a lot of students preparing for the examination in the coming March 2022. So remember that it means that, or remember that the examination date is, getting closer. And so if you are writing the March exams, all other things being equal, it means that you have done your registration. Want to just quickly look at this in that regard. So it means that you have, registered for your exams, or probably trying to wrap up for the registration for your exams. Want to check if I can get a confirmatory slide here for that. Okay, it should be okay. So I believe that you have registered and preparing, or you're preparing to register. So it means that now you are, wrapping up sort of the syllabus, and then also trying to start your revision. And it means that you start going back to the previous discussion or to the earlier discussions to begin to look at a few things that you need to look out for to be able to pass the examination. So if there are any questions, put it in the chat for me, put it in the comment section for me. I'm going to be taking some questions, and then we will get excited into our discussions for the day. We'll get into our discussion as well for the day. So remember, our books are still available. We still have copies of some of the books available. Strategic Case Study, for instance, it's available that you can get copies of. And then also you can get books relating to financial management, corporate reporting, taxation, public sector accounting and finance. All these books, you can get access to them by reaching us on the number. You can see the number there, 0501149296, and delivery can be arranged for you. You'll be able to get access to these books and use them to study for your examination. Okay. All right. So let me bring up my screen, and let's get excited into our discussion. Now, so in our last meeting, we discussed the issues relating to financial instruments. And if you remember, we solved two questions, one on financial assets, and remember the principles we mentioned and explained, and the other was on financial liability. We saw the principles and the way we are supposed to do the treatment for the item generally at the end of the day. The final part of this discussion is to deal with issue of convertible loan notes. So if an entity issues convertible loan notes, how do we deal with it? So issue of convertible loan notes. Remember, the key word here is issue. If an entity buys or purchased convertible loan notes or acquires a convertible loan note, that is still a financial asset. Okay? If an entity purchased a convertible loan note, that is a financial asset. It doesn't change the treatment. But our concern here is where the entity issues a convertible loan note. Now, in accordance with IFRS 9 and IAS 32, Generally, convertible loan notes are to be treated as compound financial instruments. The reason is that holders of this kind of loan notes have the rights but not the obligation on the date of redemption to convert their bonds into shares. They have the right but not the obligation that on the date of redemption, instead of taking their money, they can decide to convert it into shares. So anytime an entity issues a convertible loan note, it is important that the two components will be determined at the initial measurement. We are to know the debt elements of the loan notes, which is really how much we owe the person or the bondholders, and then the equity element has to also be determined. So the debt element determined, the equity element also determined. Now, the question we then ask ourselves is, how do we split the debt element to the equity element? How do we split the proceeds we've had into debt element and equity element? Like I said earlier, that is where initial measurements comes in for us to be able to work that out generally for the period under review. So how do we initially measure this? Very simple. Number one is to calculate the debt component. So we're going to calculate the debt component. We calculate the debt component. But the question we ask ourselves is, how do we calculate the debt component? Pretty simple. We calculate the debt component by discounting the cash flows on the instrument using interest rate of similar bonds without conversion right. Using interest rate of similar bonds, without conversion right. This is also referred to as the effective interest rate. Okay, the interest rate of similar bonds without conversion right is also referred to as the effective interest rate. Now, note that where an instrument is having it's having the option where the users can convert it into shares at the end of the day, the interest rate is lower than if the bond has no option like that. In other words, if the bond is a convertible loan note, the coupon, which is how much they are going to be receiving every year, could be maybe 15%. But assuming it's a loan note, it is just a loan note and not a convertible loan note, the coupon could be maybe 20%. So really, interest rate of similar bonds without conversion rights is always going to be higher than the interest rate or the coupon rate on convertible loan notes. So we calculate the debt component by discounting the cash flows on the bond. Remember, the way we get a cash flow on the bond is simply going to be the coupon rate on the bond multiplied by the nominal value of the bond. The nominal value. That is also the same as the face value. That is also the same as the par value. So these words can be used interchangeably by the examiner. The examiner can say par value. The examiner can say nominal value. The examiner can say face value. It's just a choice of word of the examiner, but technically it means the same thing that we are talking about at the end of the day. So those cash flows that we are going to be discounting will be calculated this way. Once you calculate the debt component by discounting the cash flows, then you go to the second step, and that is to calculate the equity component. Calculate the equity component. Technically, the equity component is just the balancing figure of the proceeds that we had. Just the balancing figure. Very sweet, simple, straight to the point. Just the balancing figure. What does that mean? It means that the equity element of the bond is going to be equal to proceeds that we had from the issue, not the nominal value. Be careful. The proceeds, because the reason I'm using the word proceeds, it's because sometimes debts can be issued, like we discussed earlier, debts can be issued at their par value, which is the same as the nominal value, or they can be issued at a discount. Okay, if they are issued at the par value, one, that means here the proceeds we get will be the same as the nominal value. So no challenge here in that case. But if it is issued at a discount, then our proceeds will be less than the nominal value. So you have to be careful about what's going on here. So that is why we say proceeds minus the debt component. And the context of the question will direct you on whether it is being issued at par or at its face value, or it is issued at a discount. The examiner will not trick you anywhere. The language is going to be clear. The statement is going to be direct in that particular case. Okay, the language will be clear. The statement will be direct in that case. So once we calculate the equity component, then the next thing is that if there is any transaction cost incurred on the issue of the convertible loan note, it will be allocated between the equity component and the debt component. Remember, the debt component here is from the step 1 or the workings 1. So any transaction cost shall be allocated between the debt and equity component. Between the debt and equity component. So that is how we deal with it. And all we are doing is initial recognition. Okay, so the journal entry here is simply to debit cash with the proceeds that we had. We debit cash with the proceeds that we had. Then you're going to credit financial liability with the debt component that we calculated for. Then the balancing figure is what is being credited to equity. Technically, that is other components of equity on the face of the statement of financial position. Other components of equity on the face of the statement of financial position. So that is the journal entry. That's how we go about it generally. Then, after the initial measurement and recognition, we need to look at a subsequent measurement. So after that, how do we carry it? So subsequent measurement. So on subsequent measurement, it's very simple here. On subsequent measurement, it's very simple. What happens is that the debt component is carried at amortized cost, because just like financial liabilities are dealt with, it is carried at amortized cost, like a financial liability. Okay, and then the equity component, there will not be any remeasurement. So there is no remeasurement of the amount. There is no remeasurement of the amount. What does that mean? It means that it is carried. It means that it is carried at the initial amount or initial value until redemption date or until the date of redemption. Sounds good? Until the day of redemption. So that is what you must understand in relation to the treatment and exactly what is going on. So usually the equity will be recognized on the face of the statement of financial position under other components of equity. So on the face of statement of financial position under equity, we will write other components of equity, and this figure will be carried at that amount on the face of the statement of financial position until the redemption date. Until the redemption date, where its treatment will depend on whether the bondholders convert or they take shares. Whether the bondholders convert or they take shares. That is the idea about initial measurement and recognition, as well as subsequent measurement and recognition. Very sweet, simple, straight to the point. Very sweet, simple, straight to the point. Any questions? Any questions? Let's see, I'm seeing some chats coming up. I don't know. Again, Matthew said, keep up the good work. Thank you, Matthew, for joining us. Then Janet A. Abraham said, keep it up, sir. Thank you, Janet. Thanks for joining us on the stream. Perez Ohimang, Tanko Basita, Josephine, Agbeshi, Matthew, Benjamin, Samuel, Mate. Thank you guys for the thumbs up and the love and the sharing of the video. Really appreciate that. Really, really appreciate that. Thank you very much. Then for those of you on YouTube also with a thumbs up on the video, really appreciate that. It helps us a lot so the video can reach other people just like you. So, if the equity component is going to be carried at that amount until the redemption date, then how will it be dealt with technically in that regard? So let's go. Let's go. The way we deal with that in that case is that on redemption, two things can happen. So I'm going to explain the principle to you, then we take a question, then you see how it all plays out. So on redemption, two things can happen. Bondholders can, convert. So bondholders, number one, can decide to redeem the debt, meaning that they would take cash. They would take cash. Then, other time, or alternatively, the bondholders can convert into shares. That's the two options available. Now, the entity doesn't elect or advise the bondholders what they should do. The bondholders have their rights and they can decide what they want to do, whether they want to take cash or they want to convert. But technically, this is what happens. On the date of redemption, we will look at how much we owe them. So we're going to bring in the debt outstanding. Usually, what is going to happen is that it's likely this is going to be the nominal value of the loan notes, because that is how much we owe them, plus any premium that they will get on redemption. So assuming they are redeeming at a premium, meaning they are redeeming above the nominal value. If they are redeeming at par, meaning they will just get the nominal value. So usually, on the date of redemption, how much is outstanding could be just the nominal value or the nominal value plus any premium upon redemption. Then remember the equity component. it's there because the equity element was arised during the time that we had the initial calculation. So that equity element, like we said, it's being carried on the face of the statement of financial position under other components of equity. When on the date of redemption, we would have to de-recognize that on the books of the financial statement. So if this is the debt outstanding, so in total, in terms of the loan notes, the convertible loan note, this is the total amount, how much we owe them, and then the equity element. Now, so in either case, this same thing is going to be there. So let me just copy this and throw it on the next slide. And throw it here. On the next slide. So what is going to happen here is that if they decide to take cash, which is the first option here, then we give them their money. If we give them their money, we'll be left with the equity element. Because when we are paying the bondholders, we just pay them the debt element or the debt outstanding. So we're left with the equity element. How do we deal with the equity element after we've paid them? The equity element is still reclassified as undistributable reserves, still under equity. Okay? So the equity element is reclassified as undistributable reserve. Undistributable reserve. Undistributable reserve. Because the journal entry here is like this. This is how the journal entry is. We would debit the financial liability, how much is outstanding at the reporting date. So financial liabilities have credit balance. So when we are debiting it, it means we are doing what? We are de-recognizing it. Then we credit the cash flow, the cash book, cash or bank, because we are giving them money. So the balancing figure is the equity, because the equity is what will be de-recognizing and then come and recognize. So literally there will not be any balancing figure here, because we will debit and de-recognize the liability, and then corresponding entry will be credited in the cash book. Like I said, the equity element will still be carried under equity on the face of the statement of financial position, only that now what we're going to be saying is that it is being reclassified as undistributable reserve. Are you getting the idea? That is the issue in that particular case. That is the issue in that particular case. Now, what if they decide to convert? What if they decide to convert? If they decide to convert, then our workings will be different. Then our workings will be different generally in that particular case. If they decide to convert, our workings will be, totally different in that regard. So let's see what we have here. What is going to happen generally at the end of the day is that when they decide to convert, that means we will issue shares to them. So we are going to determine the nominal value of the shares that they are getting. If they decide to, convert, we'll get a nominal value of the shares that they are getting. Very, very important. Very, very important. Once we get the nominal value of the shares that they are converting, what then will happen is that we will subtract that from the total amount, which is the debt outstanding, and then the item on the screen is blurry. Are you sure? Probably you don't have a good network. I don't know. I'm seeing a chart like that from Gifty Alabra. Item on the screen is blurry. I'm sure my item is blurry. Or it's your network. I think you should have a network problem, Gifty. That is why it is appearing blurry there. I don't know. Someone else can give us a feedback. Let me know if it is like that. It's clear. Okay. So it means that maybe Gift Alaba. I thought it's Gifty. But Gift Alaba, I think you should have a problem with your network. So if they decide to convert, we will determine the nominal value of the shares that they are getting. Then we will subtract it from the total amount when we added the equity to the debt outstanding. Because the nominal value of the shares they are getting will be added to stated capital of the company. Will be added to stated capital. And so once that is added to stated capital, we subtract it from the total we had here, which is the debt outstanding plus the equity element. The balancing figure goes to share premium. The balancing figure goes to share premium. And the reason why share premium is coming into town is because we are issuing shares. Okay, it's because we are issuing shares. And if you are issuing shares, certainly that is what is going to happen. When you issue shares above the nominal value, the balancing figure goes into the share premium account. So maybe, just for example, the debt outstanding is, say, 10,000. Okay, then the equity element we had at the beginning was 2,000. So it means the total in terms of the convertible loan note in our books is 12,000. So they convert. So the shares that we gave them, the nominal value of the shares that we gave them, it's, say, 8,000. So it means the remaining figure 4,000 goes to share premium account. That's what we are trying to say here. The remaining figure 4,000 goes to the share premium account. That is the idea about that. That is the idea about that. And that is what we do with convertible loan notes. So the treatment upon the date of redemption usually is based on whether the bondholders are converting or they are taking their money. Whether they are converting or taking their money. That is the idea in that case. So let's crunch some numbers and let's see what we can do in that particular case.